If you've invested lately, you'd be well aware of the ups and downs we've experienced in the last couple of years. From political uncertainty within South Africa to political uncertainty worldwide. From New Year's resolutions to a worldwide shutdown. Investing in 2020 certainly wasn't easy on our emotional wellness. And investing in today's day and age has forced us to become more precise, with very little space to account for error. We can't really rely on the factors we did a few years ago. We have to be flawless and perfect with our asset allocation, which is a good thing, but it's not easy to live up to clients' expectations. I was recently asked by the Financial Planning Institute to talk about the best performing funds of the last year. And to be honest, I learned a few things myself. It changed the way I look at a client's portfolio, and I thought I'd share a bit of what I learned with you today. Hopefully, this will help you make more informed decisions the next time you review your portfolio. But before we get to that, please don't forget to hit that subscribe button and hit that notification bell for more videos like this one. It's pretty much the only way I can make these videos possible. When choosing investment funds, there are a few things you want to watch out for. If you've ever received an investment statement, this might look familiar. When you invest, you need to choose an investment fund. To simplify things, there are hundreds of different types of funds, and choosing between them might become a difficult task if you don't know what to look out for. Let's start by looking at some of the factors I like to look at when comparing investment funds. Every fund should have what is called a fund fact sheet. Now, the fund fact sheet is a summary of the most relevant information you need to make a decision. The first thing to look out for is the fund manager. Now, the fund manager is the person in charge of the fund. They normally have a team of analysts and economists working at the company to help them with making the right investment decision on your behalf. It's important to note who manages your money. Fund managers become well known for their great track record. But fund managers can change over time, and this can influence your fund's performance. The fund manager is guided by the fund's objective, which in turn is affected by the fund's mandate. The fund's objective will give you a good idea about what the fund is set out to achieve. This will certainly help guide you whether this investment fund is suited for your investment needs. The investment's objective might be to preserve capital or, for example, to maximize growth. Depending on this objective, it will influence the fund's mandate to the extent of what they're allowed to do. A fund whose objective is to preserve capital will probably be restricted to the amount of risk they're allowed to take. Whereas a fund that makes maximum growth will have more freedom to roam when it comes to investing in riskier growth assets. Depending on their mandate, funds are split into different categories. Different categories such as South African portfolios, global portfolios, regional specific portfolios, and so on. They then go on and split them even further into different subcategories, like equity portfolios, multi-asset portfolios, interest-bearing portfolios, and real estate portfolios. The idea is to help investors compare funds against one another, and in general, help investors distinguish between the different types of funds. Fund size play a big role. Large funds such as Allan Gray, Coronation, 91, and so on are like the old guys from the block. They come with a lot of wisdom and a long-standing track record. I like to use the analogy of comparing funds with ships. Large funds are like tanker ships. They can't turn very quickly, but they usually have a lot of momentum, whereas smaller funds are like speedboats. They're more agile and can make quick decisions. Larger funds are more consistent with their holdings, whereas smaller funds are more actively managed. When large funds have a large exposure within a company, they have some influence within the company. They can play a big role in how the company is run, which is certainly a good thing for investors. But there's a downside. With them owning such a large stake in a single company, they become restricted to the amount of shares they're allowed to sell. Just think about it. They can literally sink a company by manipulating the share price. They can stir panic in the market by triggering a massive sell-off by selling all their shares. And that's why they're more regulated. If you take a fund like Allan Gray's Balance Fund as an example, the fund size is 127.3 billion rand. 9.6% of the fund is invested in a single company, Naspers. This means that they own more than 12 billion worths of shares in a single company. Now, selling 12 billion rand worth of shares is pretty much impossible. When a company like that is having trouble, a fund like Allan Gray will pretty much have to ride it out. Now, this is where the smaller boutique funds can play a role. They aren't able to have such a large exposure to a single company, and they're less regulated to the amount of shares they can sell. They know this and use this to their advantage. They can take a much more active approach when investing. They can act quickly and decisively and increase or decrease their exposure within a given company or asset class. We've seen this work very well during the pandemic, where a boutique fund such as Resco have performed exceptionally well. They were able to actively steer their clients' money away from suffering massive losses during this pandemic. There certainly is a place for small and large funds within your portfolio. And this brings me to my next very important point: track records. Pay close attention to a fund's performance over time. If a certain fund performed very well, make sure they have a decent track record and not only 1 or 2 lucky years. So, consistency is key, especially over time. Next, you want to take a look at the benchmark. The benchmark is the key measure of the fund's performance. The benchmark is normally based on a composite of several asset classes or an index. This allows us to see how consistently funds perform against similar funds within the same category. Did the fund consistently beat the benchmark? If the fund underperformed against the benchmark, you need to know why. This could be as a result of a strategic decision the investment fund made. This decision might see them underperforming in the short term, but will pay dividends in the long term. And that is why it's vital for consistency over time. It's so important to understand your fund's objective and mandate. Certain funds will have a long-term view, and judging them on their short-term performance might not be fair. Next, you want to take a look at the fees. Investing isn't free, and paying an investment fund manager to manage your investment might seem like you're wasting money. But trust me, it's a small price to pay compared to the amount you might lose if you don't know what you're doing. And besides, they've already done all the research and due diligence on where the best place is to invest. If you think you're going to perform better than some of the best fund managers in the world, well, good luck with that. The TER, or total expense ratio, will show you what the total cost will be to invest in a given fund. More actively managed funds might be a little bit more expensive compared to funds that are more passive. That is why using tracker funds that track a certain index is a very cost-effective way of investing. The asset allocation is also very important. This shows you if a fund is overly exposed to a certain sector, and if that sector would come under pressure, that would inevitably have an effect on your fund's performance. The top 10 holdings are also very important. It shows you what the top 10 companies are that the fund invests in. The number one key to investing is diversification. Not to put all your eggs in one basket. This will lower your overall investment risk. If you invest in one fund, you are not diversifying. Investing in several funds are very important. But what is more important is to invest in funds that do not correlate 100% with each other. In other words, you want to invest in funds that do not invest in exactly the same companies and sectors as the funds that you have in your portfolio currently. Now, this might sound straightforward, but in South Africa, there aren't that many investable companies. And that's why it's so important to make use of a CFP professional like myself to assist you in finding that perfect combination of funds that perform well together. The fund statistics can help you determine how risky a fund is compared to others in the same category. The standard deviation measures how volatile a fund is. The higher this percentage, the more volatile the fund is. It measures the average positive and or negative movement of the fund over a period. In layman's terms, if a fund had an average growth of 10% over a particular period of which they refer to, and the deviation is 7%, you can expect an average movement of either a positive 7% return on top of the average or negative 7% return on the average. The maximum drawdown is, simply put, the maximum loss the fund experienced from the fund's peak to the fund's lowest point since the fund began trading. The highest annual return is the highest return the fund did in a single year, whereas the lowest return is the lowest return the fund did in a single year. The fund will also indicate the percentage of positive months it had. And now lastly, but certainly not the least, is the income distribution section. Funds will list when they regularly distribute earnings from interest or dividends. Many investors are disappointed when they look at their fund's performance, but they tend to forget that this might be before the fund distributed their earnings, just to see the value increasing significantly thereafter. That is why it's so important to take this into consideration when looking at your investment statement. Finding the right combination of funds might be tricky. And that's why it's so important to make use of a CFP professional that will help you with this process to maximize return and lower your overall risk. A CFP professional will not only help you find the right combination of funds, but will also help find the best investment vehicle for your needs and in terms of taxation. A perfect fund doesn't necessarily exist, but making an informed decision and deciding which of the above factors are more in line with your investment strategy will bring you pretty close. For more videos on investing, check out the channel. And if you found this video helpful, please consider subscribing. 90% of you watching this video aren't subscribed already. If you have any questions, let me know in the comment section below. And don't forget to like that smash button. Until next time, bye-bye.
Thank you!